Equity method of accounting. As we saw in the previous learning objective, the equity method is used when we are able to exercise significant influence over the investee, and that's going to be 21 to 50% ownership. We're deemed to say, again, significant. If we have an equity method investment, we're going to account for it on the balance sheet in the investment section, and we're going to see that we're going to do things a little different with the equity method, in that since we have significant influence, we're going to handle the way we receive income and handle the way we receive dividends a little different. Let's look at an example to see how this works. On March 31st, we purchased 25,000 shares of Bamberg for $7 each. After we made the purchase, Bamberg had 78,125 total shares of common stock outstanding. And you see the fair value of the net assets, the book value. We see the dividends of Bamberg for the year, and then we also see the net income. And we earn that net income evenly throughout the year. Okay. Let's look at the initial purchase. We bought 25,000 shares at $7 each, which is $175,000. We debit investment, credit cash. One thing to note is that this entry is the same under the cost method as it is under the equity method. Debit investment, credit cash. Well, at this point we don't know what percentage of the company we purchase. Let's go ahead and compute that. 25,000 shares divided by 78,125 shares total after the acquisition gives us 32%. That means we have to use the equity method of accounting for this investment. We're going to look at the differential computation before we get into the equity method of accounting. Under this scenario, the purchase price is $175. We saw that. The fair value of the net assets, I said, was $546,875. That's at 100%. Okay. We're going to ignore the NCI for the equity method of accounting under this scenario. We'll see under consolidation we'll handle it a little different, but the basic foundation is going to be like this. So 546 times 32% is 175. So we see that the fair value of consideration is the same as the fair value of the net assets, which means no goodwill. And then we have no excess fair value over book value. Here's where one of the differences in the equity method of accounting comes in. Since we're deemed to have significant influence over the investee, we share in their income, dollar for dollar, whatever percentage of the company that we own. In Bamberg, we bought this on March 31st. So what we've got to do is we've got to prorate our income. So that means we didn't own the company for 12 months. So from January through March, we can't share in that income because we didn't own it. So what we're going to do is take the net income, multiply it by our ownership percentage, times the number of months that we owned it, 35,160. Now here is where the differences start. We're going to debit investment Bamberg and credit investment income. What we're going to see is the investment account under the equity method is going to kind of be like our retained earnings in Bamberg. That's going to reflect our initial investment plus any net income we have, and we're going to see in the next slide less any dividends. But for now, we're going to prorate our income based on our ownership percentage and the number of months that we own it. Dividends. Bamberg pays dividends on December 31st for $87,000. Do we prorate the share of dividends? We do prorate it based on the level of ownership, but we do not prorate it based on the number of months. Remember, Dividends are paid at a specific point in time. So whoever owns the stock at December 31st receives the dividends. If the dividends were paid in January, February, March, we wouldn't receive any of those dividends, but any dividends from April 1st through the end of the year we would receive. Notice what's going to happen though. We're going to receive cash, $27,840, and we're going to reduce our investment in Bamberg by the same amount. With the equity method of accounting, the net income raises it, and the dividends basically are a return of capital on our investment. This is something that you need to become familiar with doing. I know that you can do a T account. We're going to do an investment summary from here on out. We want to know what makes up the balance in the investment account. In this instance, we started with 0 because we bought the investment on March 31st. We had our initial investment. We increase our investment by our pro rata share of income and reduce it by the dividends that we've received, giving us an ending balance of $182,320. And this is going to be the balance that's reported in the investment section on our balance sheet